Good morning, everyone, and Happy New Year. My name is Chase Hill, and I'm a partner and head of our tax department at Heritage Wealth Advisors. It's my pleasure to welcome all of you to our first quarter 2022 Market Outlook webcast. But before we get our program today, I do have a couple of housekeeping items to cover. First, we will be recording today's session, and a replay will be available on the website for viewing later. We also welcome you to answer or to ask some questions as we go along, which we plan to answer at the end of our prepared remarks. You do not need to wait until the end of the call to begin asking questions. Everyone should have a Q&A button located at the bottom of the screen, and we encourage you to write in your questions throughout the program, and we'll get to as many as we can before the end of the call. I'm pleased to be joined on our call today by Jay Jordan, our Director of Investments, and Carrie Baronian, our Director of Research. During the course of the call today, we'll hear from each of them regarding our views on the economy and markets, as well as our current positioning and client portfolios. And at the end, I'll also provide an update on tax legislation and other planning developments that we are monitoring in the year. So before we turn our attention to the overall economy and our positioning, Jay, it seems appropriate maybe to take a few minutes to address the recent increase in volatility we've seen in markets over the last few weeks. And we'd appreciate your thoughts and any insight on the factors that have fed into this recent activity.
Absolutely, and thank you, Chase, and good morning, everyone. And Chase is right. We have certainly started the year with a meaningful level of volatility. In fact, we have experienced essentially a normal correction, if you define a correction as a 10% decline in stocks. In fact, the U.S. S&P 500 is down right at about 9% year to date, and the NASDAQ, or the more growthier segments of the market, are down closer to 15%. Now, corrections are a normal portion of the market, of any market cycle, but our hope today is that we can help define some context behind the risk that are being weighed by investors, and as well as the rationale for our continued bias towards quality and away from speculation in the market. But I think in order to really understand where we are in terms of the market, I think to start, to place it in the context of the market last year, where we had, again, very strong market returns, particularly in U.S. equities, and particularly in some areas, including the mega cap tech sector, where they've been the leaders of the market for an extended period of time. But they were joined in 2021 by some more cyclical areas, including the energy sector. Now, what's interesting about last year, though, is that while absolute index returns were very strong, there was quite a bit of volatility underneath the market. In fact, we began to see some more speculative areas of the market, meme stocks, cryptocurrencies, as well as some of our very high growth, potentially high growth businesses correct on the order of 50, 60, even 70%. And so I think that when you look at the index in 2021, it hid more volatility that was actually occurring under the surface. And so as we look to 2022, and we think about the outlook for the markets and the outlook for the economy, I think you have to place those in the context of the risk that we'll discuss and identify. Now, at the same time, what was occurring in 2021 is, while equities were relatively strong, fixed income, traditional fixed income, was actually weak. We had a negative return for only the fourth time in 30 years, associated with a modest rise in interest rates. And we'll talk in specific terms around how we are viewing interest rates and inflation a little further in the conversation. But you did have a bit of a bifurcation in 2021 between equities and fixed income.
Thanks, Jay. And now I'd like to turn the program over to Carrie Baronian. And, to get started, Carrie, in addition to Jay's comments about recent volatility, I'm wondering if you could expand on our current views on the broader economic backdrop.
Sure. Looking forward, we believe the path of the economy and monetary and fiscal policy will continue to be very important determinants of future investment returns. From an economic growth perspective, current estimates are for 2022 U.S. real GDP growth to come in at 3.5%, which would be below the 2021 peak, but still above trend. This chart shows the U.S. Leading Economic Index, which is a composite of economic indicators which historically have predicted changes in economic activity. You can see the index surged off its 2020 low last year and has started to roll over, but is still elevated, which we believe suggests economic growth that will be above trend but slowing. Turning to monetary policy, while the Federal Reserve is expected to implement tighter policy this year to help bring inflation under control, we believe their current guidance will result in policy that is still accommodative. For example, if the Fed raises the Fed funds rate 4 times this year, starting in March, which their current guidance suggests is likely and the market is anticipating, the Fed funds rate will still only be about half what it was before the pandemic. Additionally, if the Fed allows maturing loans to roll off its balance sheet starting in the middle of the year, which the minutes from the December Fed meeting suggest is likely, the balance sheet still isn't expected to return to pre-pandemic levels for several more years. Turning to fiscal policy, we saw several rounds of stimulus passed last year, including an infrastructure spending bill. While we believe the pace and magnitude of stimulus will moderate this year, we still believe that fiscal policy will remain supportive. We think it's very important to note that direct government spending on goods and services was actually pretty modest over the past 2 years. The primary driver of the surge in the budget deficit was transfer payments. And unlike direct spending on goods and services from the government, which is expected to accelerate over the next few years, households actually saved a large portion of the transfer payments. So the incremental benefit from new and existing stimulus should actually increase even as the budget deficit potentially shrinks. Outside the U.S., developed and emerging market economies continue to recover. This chart shows the purchasing manager indexes, which estimate manager expectations for manufacturing and services activity. A reading above 50 indicates expectations are for growth, while a reading below 50 suggests expectations are for contraction. You can see PMIs for the US, Eurozone, Japan, and China are all residing above 50, which indicates expectations for continued economic expansion.
So, Carrie, given the trends you touched on across the broader economy, how does that translate to the outlook for corporate earnings for the year ahead?
Sure. So, given the backdrop for the economy and monetary and fiscal policy, the outlook for corporate earnings is still positive. Specifically, consensus expectations for 2022 EPS growth are mid to high single digits. You can see here with the U.S. expected to lead the rest of the world. With that being said, we think it's really important to note that specific sector and individual company profit growth may vary widely due to the unevenness of the recovery. For example, industries and businesses leveraged to stay at home and work from home trends never really saw their profits decline during the pandemic. And now they're facing very difficult year over year comparison periods for growth, given that their profits have actually surged to this point. Conversely, there are other businesses such as those tied to travel and leisure, elective healthcare procedures that saw their profits significantly adversely impacted during the pandemic. And they've been very slow to recover due to the ongoing waves of new COVID variants. This chart shows real personal consumption expenditures for goods on the left and for services on the right. You can see that spending on goods has been running well above trend, while spending for services has been running well below. To us, this suggests a level of demand has been pulled forward for goods, while a level of demand is pent up for services, which we believe should carry through to specific sector and individual company profit growth this year.
Thanks, Carrie. So, I know we spend a lot of time discussing risks and the potential impact of those risks to our views, some of which you acknowledged in your opening remarks about the recent volatility. I was wondering if you could expand on those thoughts and how you're viewing risk in the current environment.
Absolutely. And certainly risk is central, and our assessment of risk is central to our overall views and our management of client portfolios. And so I think it is important to walk through a list of the risks that we're considering as we think about the path forward for both the economy, earnings, and ultimately the markets. And so when you look at where we are today, and I think, as Fed Chairman Powell stated as recently as yesterday, we're in an environment of deep uncertainty. And Carrie just laid the backdrop for, the potential for continued or even accelerating economic growth. The challenge is that the ultimate outlook for the economy and the markets, in our opinion, is heavily path dependent. And what do we mean by path dependent? Specifically, we're thinking and considering the path of the virus, the path of inflation, and then equally, as a result of that, the path of the Federal Reserve and monetary policy. And we believe that when you look at those three together, the implications for the economy and for markets are certainly material. So if we start with the virus, and certainly we're hopeful that we'll ultimately reach herd immunity, each variant cycle has stalled the recovery, particularly in the service sector that Carrie was just speaking to. And while at the same time, also really extending some of the supply chain issues, which have been pressuring prices and creating rising inflation. So that is something we continue to pay close attention to. But on the flip side, if we ultimately move back into a some level of return to normal economy, the pent-up demand associated with recovery and the excess savings that Carrie mentioned could potentially stress existing supply-demand imbalances. So in either scenario, in our minds, inflation has to be a focus for the Fed, and it has to be a focus for us specifically as investors. So let's talk about inflation for a minute. And when we look at inflation, and this is a graph of inflation going back to 1970, and I think the point here is that we've been in a period of 40 years of declining and then stable rates of inflation at relatively low levels. And that has provided quite a bit of latitude, honestly, for the Fed to spend more time focused on the mandate of full employment than necessarily the mandate of stable prices. But right now, the Federal Reserve is confronted with inflation levels that we haven't seen in 30 years. And while there's certainly a case to be made that we could see a modest moderation in inflation rates in the near term, for instance, when we do begin to see some resolution to some supply chain issues, we remain concerned that the case for structural inflation is strengthening. And let me list a couple data points to support this view. The first would be simply the expansion of the Fed balance sheet and the resultant extraordinary money growth. M2 growth has grown by over 36% over the last year. The Federal Reserve balance sheet has almost doubled over an extended period of time. And that has really flooded the markets and the economy with liquidity. So, if you think about the dictum of, too much money chasing too few goods, this is not a transitory dynamic in place in the markets, and something that we're paying close attention to. Secondly, home prices have risen sharply. Home prices are up 20% over the last year, while at the same time, housing imbalances remain, which suggests to us, as we think about traditional inflationary indices, that we're likely to see rental prices continue to rise in this environment. Thirdly, commodity price fundamentals remain strong. And we've seen commodity price inflation to date. We have oil prices now at close to $85 a barrel. But what's interesting is the last time we saw oil prices at these levels, capital expenditures on exploration and production were 3 times the current level of E&P. And so there's certainly a structural argument to be made that we will be in a higher commodity price environment for an extended period of time. And then finally, wages are likely to continue to accelerate. If you look at the labor market, labor markets appear to be structurally tight. This is a chart that shows that job openings there are currently more job openings than there are unemployed people in our current labor force. So that is certainly a dynamic which would suggest that we would anticipate that we'll continue to see pressure from a wage inflation, which is more durable in terms of the impact it has on long-term inflation. The rising inflation and, importantly, inflation expectations are going to force the Fed to choose between growth and ultimately needing to curtail rising price levels. But as Carrie mentioned, current Fed policy remains highly accommodative, and the yield curve as well remains positively sloping. What does that mean? That should provide a support for the outlook for the economy. An accommodative Fed, even in the context of potentially rising rates over the course of this year. The Federal Reserve is still going to buy at the end of their QE cycle. They're going to buy over $40 billion in treasuries in the month of March. And so there is still significant accommodation from a monetary policy perspective. But there is an if, and it's a big if. And that if is if inflation is not transitory, then the Fed is meaningfully behind the curve in our minds in terms of adjusting monetary policy, potentially setting us down a path of more aggressive tightening. And the implications matter. They matter for both the economy and they matter for the markets if we find ourselves in an environment where the Fed has to be is more reactive in adjusting interest rates to a more durable, higher level of inflation. And where the Fed finds themselves, and this is the real challenge. It's the challenge for the Fed. It's the challenge for investors. Is that we're in an environment where again, Carrie pointed out that consumer and corporate balance sheets are very strong with high levels of savings, but it appears that quite a bit of those savings really resulted from or were funded by the transfer of dollars from the federal government into particularly consumer balance sheets, and the resultant spike in government debt, coupled with the fact that we have financed that debt with very short-term financing. Over about 50% of the outstanding government debt currently out there matures in less than 3 years. That's important because what that means is that potentially that hampers the Fed's ability to raise interest rates without having an outsized impact on the overall economy. So really, this is the tightrope that the Fed is walking in an attempt to satisfy that dual mandate of both price stability and full employment. And it certainly frames our views in terms of how we are thinking about how we position portfolios and how we are managing risk and attempting to manage risk across client portfolios.
I mean, Jay, with everything you just laid out, from a risk perspective, what does that mean more specifically, though, for financial markets?
So ultimately, the Fed path matters for the economy and for financial markets, and that's based on a view that the level of interest rates impacts pricing across all markets that are valued on cash flow. So that includes equity markets. It also includes real estate. But when we look at equity markets, for example, the challenge is that while equity markets remain attractively priced relative to very low interest rates, and this is the TINA view, that there really is no alternative in the current market environment to owning equities, and that there is certainly a rationale when discount rates are lower that prices should be higher, but absolute valuations remain at or near historic highs across the board. And the challenge for investors is that this argues strongly for lower expected levels of return at potentially heightened levels of volatility for the overall market. And so the path of the Fed, the path and the speed of increases in interest rates is going to be important to overall returns, as they're certainly in an expectation of in a continued growing economy and continued growing earnings. But market returns to date have been not only supported by growing earnings, but also by multiple expansion, by valuation expansion. And in an environment of rising interest rates, our expectation would be you are going to become more dependent upon earnings growth. And those areas of the market that are particularly highly valued are at risk of seeing multiple compression, taking away some of the return that would be associated with that earnings growth. Now, structurally, we also have concerns as it relates to the concentration in the market. And this is something we've been talking about now for several years, both from an individual stock perspective, whereas you can see 25% of the weight of the S&P 500 resides in 5 companies, but also from an economic sector perspective, where almost 50% of the economy is in businesses and sectors that are generally exposed to similar broad spending trends as they relate to the economy. And while the trend towards indexing in this environment of excess liquidity has both enhanced this concentration as well as advantaged index returns, in an environment of declining liquidity driven by a less accommodative Fed, we could see a reversal of this dynamic, which again points to the argument and our positioning to try to steer further away from the index and continue to emphasize quality within our client portfolios. And then finally, correlations across asset classes have been rising, particularly in the most aggressive, speculative, highly valued areas of the market relative to interest rates. And while we've seen some pretty significant declines in highly speculative areas of the market to date on very modest increases in interest rates, our view is that the continued increases in interest rates poses a continuing threat to those most highly valued, growthiest areas of the market. And so, I think what Carrie will now walk us through is some of the positioning around how we are thinking about our client portfolios in the context of managing risk while also still building for the future.
Yeah, so Carrie, that'd be great if you could maybe take us through client positioning, kind of with that as a backdrop, what we're doing with it specifically within client portfolios.
Absolutely. Given the backdrop Jay just described, the valuation and structural challenges of the market, we have deep conviction in owning a basket of high quality businesses with strong growth and income characteristics at reasonable valuations. We believe this is the best way to manage risk and position client portfolios to generate acceptable returns in the future. We therefore are continuing to lean against the S&P 500 and own our concentrated leaders portfolio as the core of U.S. large cap exposure in client portfolios. This table compares the attributes of concentrated leaders to the S&P 500. You can see the portfolio's favorable quality rating, higher normalized growth rate, higher dividend yield, and lower valuation multiple than the S&P. Can also see on the far right side, the portfolio has a beta of 0.9, which means it historically has exhibited modestly lower volatility than the index. The next page shows the logos of the current holdings in concentrated leaders. We selected these businesses because we believe they are best in breed with understandable, defensible business models, sustained earnings power, and strong balance sheets. We have confidence in the durability of their competitive positioning and their ability to weather any type of environment. We purchased them with the intent to own them over a full market cycle. You can see we own several of the mega cap technology companies that led the market higher last year. For example, Apple, Google, and Microsoft. We believe they are exceptional businesses, but we are holding them at smaller position sizes than their weights in the index, based on a view that elevated valuation multiples reflect significant positive expectations as well as increased sensitivity to a backup in interest rates. We also saw strong performance last year from names in the portfolio that operate in more cyclical sectors. For example, ConocoPhillips in energy, Berkshire Hathaway in financials, and Raytheon Technologies in industrials. These businesses benefited from a recovering economy, and in our opinion, they remain attractively priced. They've also supported portfolio performance this year as they historically have generated excess profits during periods of rising in inflation and backup in interest rates. We also own a group of businesses that operate in more defensive sectors, for example, Merck in healthcare, Pepsi-Cola in consumer staples, and Dominion in utilities. We saw these businesses lag last year, but they've been holding up a bit better than the S&P 500 this year, given concerns about a slowdown in economic growth. As we've discussed previously, we take a tax-efficient, low-turnover approach to managing concentrated leaders. But with that being said, we have taken a couple of actions in the portfolio recently that we believe enhance the risk-reward characteristics of the portfolio. For example, in December, we took profits in Home Depot, which had been an outsized performer, and we reinvested in MasterCard, which has been underperforming due to the overhang of COVID-related travel restrictions on cross-border spending. We continue to believe that MasterCard is a high-quality business poised to benefit from pent-up demand in travel and leisure spending, as well as the ongoing secular shift from cash to cashless payments. Additionally, we took advantage of the pullback in technology stocks recently to initiate a position in Facebook. Facebook, now known as Meta Platforms, is the largest social network in the world with about 2.5 billion monthly active users. The company has been increasing its user base and driving increased user engagement by developing additional features and apps on its platforms, which is allowing the business to place targeted ad campaigns more effectively in front of a large and growing audience, bringing significant value to advertisers. Meta should continue to benefit from the ongoing shift in ad spend toward online advertising. Company is also taking steps to further monetize its apps, for example, tapping into e-commerce. Additionally, applying virtual and augmented reality technologies to various products, which may increase user engagement and support future growth. We believe the stock possesses numerous attractive characteristics. For example, free cash flow yield above the S&P 500, also trading at a valuation multiple below its historical average. While utilization of consumer data is under scrutiny, we believe the stock's current valuation multiple is appropriately discounting this uncertainty. So really believe that we've purchased a high quality business at a compelling price point. Looking at a few other strategies in the portfolio, we remain positive on natural resource equities. You may recall we established a position in 2020 based on a view these businesses possess attractive growth, income, and diversification potential. Specifically, we purchased the GMO natural resource strategy, which invests in global commodity producers in energy, industrial metals, and agriculture. We've seen these stocks outperform, and in our view, they remain attractively priced. They also have historically grown purchasing power for investors during inflationary periods. This chart shows 8 different periods where inflation, as measured by the Consumer Price Index, was greater than 5% per annum for a period longer than a year. Each mini chart compares the performance of natural resource equities, that's the blue bar, to the S&P 500 as well as inflation. You can see in each period, the resource equities outperformed the S&P 500, and in most periods, not only kept up with inflation, but actually outpaced inflation. Additionally, we remain positive on gold. While the price consolidated last year, we continue to view it as a very important long-term strategic allocation in portfolios, potential insurance policy against the possibility of a weaker dollar, and essentially a store of value. This chart shows that the price of gold has started to move higher over the past couple of months, which we believe reflects increasing economic policy uncertainty, as well as deteriorating confidence in the Fed amid rising inflation. From a fixed income perspective, we continue to emphasize short and intermediate term high quality securities. As we've discussed in the past, we've avoided taking significant duration risk in portfolios based on a view we weren't being adequately compensated. Just a small increase in interest rates could result in a capital loss that more than offsets the incremental income associated with a longer duration bond. And we actually saw this dynamic play out last year with the Barclays Aggregate Bond Index posting a negative return. And as interest rates have moved higher this year, we've seen similar performance so far. From a sector perspective, continue to favor high quality tax-free municipals over governments and taxable corporates. Also continue to hold a modest allocation to preferred securities to drive incremental income. This chart shows high yield credit spreads, which estimate the incremental income associated with high yield corporate bonds. You can see spreads are the tightest they've been since 2007. Which to us suggests investors aren't being appropriately compensated for the credit risk associated with these bonds. We therefore continue to favor taking economic risk in high quality equities rather than the high yield markets of fixed income. And then lastly, we continue to evaluate private markets to identify strategies that enhance the risk reward characteristics of portfolios. When we think about the current backdrop for financial markets, including still an ultra low interest rate environment and elevated valuation multiples across the broad equity market, we believe very strongly investors are going to need to embrace other types of assets, alternative investments such as private investments, embrace the illiquidity characteristics of those markets in order to generate acceptable risk-adjusted returns in the future. As we've discussed previously, there are different types of private investments, for example, private real estate, private credit, and private equity. And depending on their characteristics, they play different roles in portfolios, for example, growth, income, or a combination of the two. Within fixed income, within private credit, we believe that Owl Rock's direct lending strategy represents an attractive income solution for many client portfolios.
Thanks, Carrie, and thanks, Jay. Appreciate those comments. Once again, I want to remind everyone that if you have questions for either Jay or Carrie, to please use the Q&A button at the bottom of the screen to submit your questions. Before we get to those questions, I just want to take a few minutes to provide an update on the tax front. On our quarterly call last quarter, we had highlighted the Build Back Better legislation, which included some major potential changes to tax law. And within days of our call in October, the legislation had already changed pretty substantially, and then by the end of 2021 had been tabled by Congress. As we enter into a new year, Congress and the President continue to discuss the various elements of this legislation. And just last week, President Biden suggested he'd be willing to break up the Build Back Better plan into more manageable chunks to see what could pass now, and then return later in the year to passing other pieces. At the same time, he also acknowledged that the enhanced child tax credit, free community college, paid leave, and several other positions will likely have to be left out of the bill entirely if it has any hopes of passing. And of course, within days of those comments from the president, we've already heard additional comments from members of both the House and Senate voicing various levels of approval and disapproval of those different pieces of legislation. And so I would say, given, now that we've entered into a midterm election year, along with the recent track record of Congress, really not being able to get much done, our prediction is we're likely not to see much pass this year. But of course, we'll continue to monitor those developments and provide you all with information as they unfold. Now, while we didn't see any major changes driven by tax legislation at the end of the year, there's still a number of changes this year worth noting, including, each year the IRS announces cost of living adjustments to more than 60 tax provisions. With inflation up significantly over the last year, many of these saw larger increases than what we've seen in recent history. And we're not going to cover all of these increases, but we have listed several key ones that affect many of our clients in the tables included with today's presentation. Notable increases included here are the annual increases to contribution limits for retirement plans. So for those of you making contributions to 401k or 403b retirement plans, this annual contribution limit has increased by $1,000 to $20,500. So if you're maxing out your plan, you want to make sure that you make that adjustment on an annual basis. And also, please don't forget, the $6,500 catch-up contribution for those that are age 50 or older. We also like to highlight contribution limits for health savings accounts, which have increased in popularity over the last 10 years. The limit for these plans depends on whether it's a single plan or a family plan. And so for a single plan, the limit is increased to $3,650. And for family plans, that limit is now $7,300. And like retirement plans, there's also a catch-up contribution available, in this case of $1,000. But this catch-up contribution applies to individuals over the age of 55, not 50, like the retirement plans. Now, for estate and gift taxes, we've seen our first increase in the annual gift tax exclusion since 2018, increasing from $15,000 to $16,000. This is the maximum amount any individual can pass to another individual each year free of gift taxes. For a married couple, this means that collectively they can now pass $32,000 per year to a family member or other individual free of gift taxes. Many of our clients choose to take advantage of these limits by implementing their gifts early in the year. And over time, this can be a great way to pass assets to the next generation while lowering your taxable estate. In addition, the lifetime exemption also increased from $11.7 million to $12,060,000 per person. Various iterations of the now stalled Build Back Better legislation had included proposals to decrease this limit. But we continue to remind everyone that the limit is already scheduled to decrease on January 1, 2026, when the Tax Cuts and Jobs Act expires. So while we continue to focus on planning for 2022 and beyond, we'll also be working with many of you over the coming weeks to complete tax filings for calendar year 2021. As we enter tax season, we've been closely monitoring recent comments from both the Treasury and the national taxpayer advocacy groups about the enormous challenges and delays we're all experiencing with the IRS. For some background, when tax season began last year, the IRS was 11.7 million returns behind in processing the previous year's returns. And then when last year's tax season closed, there were still 9.8 million individual returns in the error resolution system, which require manual processing. And as of the end of the year, December 31st, there's still 6 million unprocessed returns in their backlog, including 2.3 million amended returns. These delays have resulted from several factors, including staffing shortages onset by the pandemic and an inflation-adjusted decrease of 20% in the IRS's budget over the last 10 years, combined with a 13% increase in the number of returns filed. Additionally, the pace of tax law change has increased considerably over the last 5 to 10 years, with many of these changes coming at the last minute, leaving the IRS with very little time to update forms, instructions, and regulations. It's now become normal for tax returns to be filed without complete regulations or clarity on how the IRS should interpret these new tax laws. And this uncertainty has led to a significant increase in the number of amended returns filed to take advantage of favorable, oftentimes retroactive tax positions. And of course, these admitted returns are part of the returns that have to be manually processed, which further exacerbates the backlog. There's no doubt that all of this has resulted in increasing complexity for taxpayers. We'll continue to stay on top of these developments and work with each of you to plan for and navigate these changes. And so with that, I'm going to turn the call back over to Jay, who's going to moderate the question and answer portion of our program.
Great, and thank you, Chase. And so now we're going to take a few questions, and there are already a few on the board, which we'll walk through. But I would encourage everyone, if you have additional questions, please don't hesitate to go into your Q&A button and ask additional questions. So the first question is a question asking if we would comment on our outlook for developed and emerging markets. Carrie, would you like to take that?
Yeah, absolutely. I think we would say that our outlook for both developed and emerging markets remains positive. Certainly, China is a big driver of not only emerging markets but global markets in general. And when we look at China today, one data point that stands out to us is their credit impulse, which is a measure of the type of policy that they're implementing. And today, it appears that their credit impulse is on the way towards bottoming, which should be supportive of more positive economic growth starting in the second half of the year. And that should carry forward to other parts of emerging markets as well as international developed markets such as Europe, which are more export-oriented economies. And then from a valuation and dividend yield perspective, I would say international markets today, they actually have lower valuation multiples than the U.S. and higher dividend yields. So to us, those are kind of the makings of a viewpoint that, lead us to continue to want to maintain an allocation to those regions of the world.
Thank you, Carrie. So the next question is really related to our domestic at large cap equity portfolio. And the question is essentially that, at a growth rate with earnings growth of 8% and a forward PE of just under 20 times, does that relationship make us nervous, and are we at risk of PE contractions? And I think to answer that question, I think it's important to take it in the context of, yes, we are highly sensitive in total to valuations across markets, and what we are identifying and investing in our concentrated leaders portfolio, we recognize that our expected returns in that portfolio are similarly lower than they were, call it 5 years ago, when you had the opportunity to own businesses with similar growth rates at 15, 16, 17 times earnings. And so, when we look at and when we consider businesses within that portfolio, we're really focused on making sure that we've identified companies where we're being conservative about what we believe as we look out into the future, the market might be willing to pay for their earnings. We spend a lot of time developing conviction that we believe in the underlying earnings and the earnings expectation of the company. And then ultimately, we're trying to avoid those areas where we believe that either valuations are less likely to be able to be supported over time or earnings growth is likely to be achieved. So we remain focused on developing conviction in businesses with stable free cash flows, stable earnings growth that we believe are achievable. But we do recognize that we're not completely insulated from the dynamics of the overall market. So there's one more question here currently, and it is: do you see a financial impact from the heightened political polarization we have seen in the U.S. In recent years? And I think this is one that we could all probably collectively answer, and you might collectively get different answers. I think my view and my answer is that yes, there is certainly the potential. The lack of any ability at this point to have bipartisan discussions around any sort of legislation or potential solutions ultimately has to have some impact from a longer term perspective on our economy. And certainly in the context of, the chart that we showed earlier relative to the levels of government debt currently sitting in the economy, there are a lot of hard questions that are going to have to be answered over the course of the next 5 to 10 years as we look at non-discretionary spending as an example that is now in our government budget that is now over 2/3 of the total budget. And if you were to see a meaningful increase in interest rates, it could become over 100% of the government budget. Those are challenges that we face from a broader economic and political perspective that requires that we ultimately find some path where we can have broader discussions to move this country forward. And it's one area we didn't really touch on today, but geopolitical risk in general, that's the fourth risk that I didn't really touch on when I was discussing risk, whether it's domestically or the situation that we currently face between the Ukraine and Russia, or the dynamics within China and Taiwan. Geopolitical risk appear to be rising, and that's something that we also have to address as we think broadly about risk in overall financial markets. So I'll hold for 1 second, but it doesn't appear at this point that we have any additional questions. And so we've been at this for about 45 minutes, and so I appreciate everyone's attendance, and certainly we all are available, as is everybody else within the Heritage family. We're available to answer further questions on a one-on-one basis, so please don't hesitate to reach out to us. There will be a webcast, a replay of the webcast that will be available on our website later this afternoon. So I thank everybody for your continued confidence in our team and our firm. And I appreciate your attendance in this webcast. I hope everybody has a great day.